Hi guys, welcome to my YouTube channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about debt management and repayment strategies. So make sure to watch the full video. There are a number of debt management strategies that can be implemented to accelerate wealth accumulation involving cash flow, repayment, and consolidation. Advising on debt. While you'll need to have a credit license or be a credit representative to be able to recommend lending products, advisors who are not credit licensed are still able to advise on the cash flow implications of debt, assist clients with maximizing the tax effectiveness of their debt, and accelerate the repayment of debt not associated with wealth creation. There are a number of strategies to help clients reduce bad debt and use good debt to create wealth. Bad debt is debt used to purchase anything that doesn't generate income, something that loses its value or has no value once it's been used. It's considered to be bad because a tax deduction cannot be claimed on the interest expense incurred, and the debt doesn't generate any income, and the borrower has to use their own cash resources to repay the loan. Examples include credit and store cards. Using these to pay living expenses can be inefficient if the outstanding balance isn't paid in full within the interest-free period, usually monthly. Interest charges are generally significantly higher than for other loans, making any cheap purchases potentially expensive. Personal loans. Using a personal loan to buy a car or boat is inefficient. These assets don't produce any income, and the interest incurred usually isn't tax deductible. The interest rate is also typically higher than that for loans secured against real property. Home loans. Although residential property generally increases in value over the long term, if the borrower lives in the home, they aren't receiving income from it, and they can't claim the interest on the loan as a tax deduction. Good debt, on the other hand, is used to buy assets that generate income and also has the potential to increase in value, such as an investment property, managed funds, or shares. Investment loans are considered good debt because the income the investment generates can be used to help repay the loan. The interest costs may be partly or fully tax deductible, and it can assist with accelerating wealth creation. Control cash flow. Better utilization of surplus cash flow can help clients reduce the interest payable on their home loan. Interest on these loans is normally calculated on the daily loan balance and then added to the loan balance on a monthly basis. Clients can reduce their average daily loan balance and consequently the interest charged using one or a combination of the following options. Increase the repayment frequency. A fortnightly repayment has the impact of reducing the loan balance every 2 weeks instead of monthly, so over the term of the loan, your client can incur less interest. Increase the repayment amount. Clients can use their surplus cash flow, increasing their repayment levels to help pay off the loan amount sooner. Pay salary into loan. By having salary paid into the loan account with a redraw facility or a 100% offset account, the client benefits from effectively increasing the repayment frequency, reducing the size of the loan on a more regular basis, a higher after-tax return than what they would normally obtain from a savings account, and easy access to their funds when they need it. Using a credit card for living expenses. By using a credit card to cover all living expenses, money is kept to the client's offset or redraw account for a longer period of time, reducing the loan amount used for the interest calculation. The credit card balance must be paid each month within the interest-free period to avoid incurring interest charges on the credit card. Things to consider when advising on this strategy. Are your clients making full use of their income and tax deductions and limiting expenses? A monthly repayment amount is usually halved to demonstrate the benefits of fortnightly repayments using a home loan simulator. The client will actually make an extra 2 repayments per year when paying fortnightly as opposed to monthly. $1,000 a fortnight is the same as $26,000 per year, whereas $2,000 a month is the same as $24,000 a year. Therefore, this method requires some additional cash flow. Can the client's employer pay salary directly into an offset account or home loan? Does the home loan provider allow additional repayments? It may not if the loan is at a fixed rate, or there may be an annual limit. Does the home loan provider allow for automatic repayment of credit card balances monthly? This could help ensure timely repayments are made to avoid any unnecessary credit card interest charges. Using redraw facilities for investment loans. This strategy is not recommended to be used for investment loans. In TR 2000/2, the ATO indicated that a deposit into an investment loan containing a redraw facility is seen as a repayment of part of the investment loan. A subsequent withdrawal of some of the available funds is treated as a new loan. If this loan is used for private purposes, then the interest relating to this additional amount in new loan is not tax deductible. If subsequent deposits and withdrawals are made into or from a redraw facility, it becomes difficult to calculate the deductible interest amount. This is because every deposit will be treated as being a proportionate part repayment of the investment and non-investment component of the loan. Tax deductions with respect to investment loans. The deductible and non-deductible component of the debt must not be seen to be linked. This was a consequence of the High Court's decision in Commissioner of Taxation v. Hart, 2004, HCA 26, which was decided in favor of the ATO on the basis that the scheme involved was caught by Part IVA. Does this mean that, as a general proposition, decoupling the loans would not involve Part IVA? The decoupling of the loans would seem to make it harder for the ATO to argue that Part IVA should apply. However, it is important to note that some other relevant issues were not considered by the High Court when making its decision. It is in principle possible for the ATO to contest a claim for the full deduction in respect of an investment loan on which all the interest has been capitalized. In these circumstances, any client contemplating this strategy should seek professional advice and preferably a private binding ruling in relation to the arrangement. Effective use of cash reserves. This strategy is suitable for clients who have a home mortgage and some additional cash within a savings account. Once implemented, they can earn a higher after-tax return and pay off bad debts but still have access to their money. Spare cash in a normal bank account earns interest usually at a lower rate than what is charges within a home loan. Also, the client will pay tax at their marginal rate, up to 47%, inclusive of the Medicare levy, on every dollar they earn in interest. Things to consider when advising on this strategy. An offset facility may be more effective than a redraw facility after taking into account fees and restrictions on any redraw. Check if the client's current home loan has a 100% offset facility. If not, can it be added? Is the client's home loan a fixed interest loan, or does it have a fixed interest component? Offset accounts generally only apply to the variable rate portion of the loan, and possibly a capped amount on the fixed rate portion of the loan. Debt consolidation. Debt consolidation involves the refinancing of expensive personal and credit card debt with a more cost-effective home mortgage facility. This strategy is suitable for clients who have equity in their home but are paying off a mortgage and also have other debts such as personal loans or credit cards. They can increase their mortgage facility and use the extra money borrowed to pay off their other debts at an interest rate, which is likely to be lower. It's important that the client maintains the same repayment levels prior to consolidating their debts. If they don't, they could end up taking longer to repay the loan and incur more interest overall. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.